teamed up with A1 Trading, and now you can see all of his trades, and it's all through Discord, so I can easily check them anytime on my phone or desktop. Plus, you can get notifications when new messages are sent.
Frank, that's really cool that you can see his signals, but why are you doing that when we're space traveling?
Because I'm bored and we have light years till our next destination.
Another trade already?
Actually, have no idea what that is. We might be in trouble.
Pulver alerts are now available on the A1 Trading website, and for a limited time, you can get them 40% off for the Black Friday sale event. Don't miss out on getting Pulver alerts for the best price anywhere in the galaxy. We're dropping the link to get Pulver alerts 40% off right now in the chat and the description down below.
Nick, Frank, you watching gold?
Roger that, Pulver. We got the alert.
Hey everybody, happy Monday. How we doing? Welcome back. Just looking at everything this morning. Today seems to be pretty calm, pretty chill, which is kind of expected. That was the plan. So grabbed a few bucks out of the SPX this morning. Want to see if we just kind of avoid a big directional move today. Last week we had a pullback. I mean, just having a look at where prices are, it's pretty easy to see. We have some gaps we could potentially be playing with. This gap from FOMC is still, oops, let me change the color here. This post FOMC gap is still a possibility to get filled right in here. And then the gap from last week on, let's see, that would be Friday, Thursday, Wednesday. So Wednesday, Thursday last week, another gap just a little bit higher. So price can obviously do whatever it's going to do. We have the election tomorrow. I don't know what it's going to look like. I don't know if it's going to be, good, bad, and different. I don't know if it's going to be a victor is determined. According to 538, which is some full nationwide polling, it shows that things are a little bit tighter. This is national presidential polls showing it's pretty tight race at like 47%. So 48 Harris, 46.9 Trump. But then you go to Polymarket, Robinhood, all those betting polls that have been popping up in the last month or so, those are showing like pretty much a landslide. It's like 58 to 60+% favoring Trump. And again, I don't know if that's a real indicator of the turnout that we get for voters. Obviously you can vote absentee. You can go to the polls tomorrow, but I'm not sure what that's going to look like. So all I'll say with the election is this: it's happening, whether we like it or not, and the market's going to digest whatever happens. And I would say that the worst case scenario would be that we don't have a victor or we don't have a president decided by the popular vote and electoral college by Tuesday. So Tuesday night, if we don't have somebody declared president, then the markets might take that with a lot of uncertainty. Now, I did look at something like a vol event where, if the market, here's one thing I'm going to do. The easy trade, and I'll throw a couple of these in my Pulver alerts, but easy trade for me is just watching to see if I get long now and by the end of the year we're higher, well, that's an easy trade. Okay. If I get long now and it pulls back in a volatility play, I'm still willing to kind of get into these trades at better prices and different contract sizes. But again, the idea is I want to be longer term. So we have not only the election this week, but we also have the Fed. The Fed is expected to cut rates. That is a 99.8% probability that Thursday they'll be cutting rates. Okay. And then in December, there's another 25 basis points there, possibly a pause in January. It's about 44 to 49 right now, still favoring the cut in January. I would say that if we get cuts, cut for November, cut for December, question mark for January, and question mark for March. Okay. Going through, let's say, May to December, I would expect the Fed to pause as opposed to they cut, and then raise again. That actually would be way harder on the markets to see the Feds cut aggressively and then raise. So I hope they don't have to backpedal or pivot into, number one, pivot into a pause, number two, pivot into a raise, all because the 10-year yield continues to go higher. So 10-year, finally, we're getting some traction to the downside. It's down 2.67%. And this is going to be the big deal right here. Like this 10-year yield that has ripped up from 3.6 all the way up to 4.4, a 0.8% increase is also why we've almost had that go tick for tick with the 30-year mortgage. Right? We saw this, the 30-year mortgage go from 609 to like over 7%. All that is pretty much based on, the longer term financing in our yields. So the 10-year has gone up a ton. I would love to see the 10-year continue to head lower. If the 10-year heads lower, that means that the mortgage rates can settle down. This business refi, auto loans, mortgages, all those rates can start to settle back in. There's not really a technical play here. It's just if yields go higher because bond traders want higher premiums to hold debt, that's what the market's telling us. There's going to be some inflationary pressures, and we don't know. I mean, it's going to be month to month. It's going to be the Fed is waiting to see what the data shows, whether it's leading or lagging. Nobody knows. I don't think the Fed is going to get it all right. I think this soft landing scenario looks a little bit rougher unless something gets adjusted here, where if the 10-year drops, that's a good sign for things to kind of normalize. Okay. Ideally, I would say this. I'd love to see the 10-year yield start to settle back in and maybe pull back to like 4% or so. If we somehow, 4% is fine. If we cut another November, December, 25 basis points, maybe even again in January, and this market is still seeing relatively good data, it's not super inflationary, then perhaps this gets back into the sub 4, and all of a sudden we're looking at some fresh lows in mortgages and other things. So if we really want this like no landing, soft landing scenario, I think the 10-year yield does have to drop. So that's one thing to pay attention to. Okay, we'll do some top down here. Yep, just give me a little bit. But I'm gonna say this on the election this week. So big data this week. We got a lot of stuff going on. We have over 1,100 companies reporting earnings. It might take a backseat to what's happening with the election. So we have the U.S. election Tuesday, and then will it be officially decided? And that's the question mark. That's my one concern with the markets this week is that we don't have a winner declared, and there's going to be state to state to state, and it's going to drag on for several days, or one side says, no, that's not right. There's voter fraud, there's election fraud, blah, blah, blah. I don't know what side that comes from. I really don't care. I just don't want it to be a dramatic election. So will it be decided? I think if it's decided, good. The market checks the box and we can move on with our lives, and we'll figure out how to deal with it in 2025. We have the Fed on Thursday with a 99% probability of a 25 BPS cut. Okay. So that's what's happening all this week for the markets to digest. I don't know if the 1,100 companies are going to be as important as what we saw last week with Mag 7. That was where most of the market cap sits. This week we've got over 1,000 companies reporting. That's obviously a lot. But yeah, I think what the market's going to look at as far as the fundamentals is consensus wise, is it still good? Are we beating top and bottom? Are we beating earnings per share, beating revenue? What's the optimistic outlook? Is it good? Is it positive? Is it negative? I saw last week, I think it was FactSet released a bunch of transcripts on these earnings reports that a lot of companies were mentioning election. So once the election is over with, does it pop up on all these earnings calls? Maybe it's more just forward guidance. Okay. All right, so that's what's happening. Let's go top down. So today, again, relatively calm. We've had a pullback here the last couple of weeks to the tune of around 3%. So high to low was around 2.97% on the S&P, which is fine. I mean, a 3% pullback is actually quite minor. The one thing I would be watching for if we have any type of scare this week or any type of uncertainty would be the two gaps that I just talked about. Okay, this gap from Wednesday to Thursday last week, and then the FOMC gap from September. Okay, this could get hit and still make lower highs and lower lows. I personally would almost like to see this week, especially if we have another retest of the 50 or even a test of the 100 moving average. I'd love to see this level offer up a chance to buy a dip or a chance to use some options to get some dips. And I'll still stay longer to say going out into, let's say, Q1 of 2025, I don't mind these trades all expiring for me in Q1 of 2025 to have them be income. You know, the last few weeks, especially, it's not been big positions. I've got a lot of buying power at the ready that I haven't deployed yet. And I'm just kind of waiting to see, like, okay, I'll start positioning for income or start positioning for better time trades. I looked at a trade this morning with an earlier trade group that if we were to price out, like, okay, we've got some indecision going on with the election this week. Is there enough to play a vol event? Well, I looked at pricing out like a buy call and a buy put and try to go both directions and also sell against it. And it was going to cost me about $13 to max out at $15 or $20. So that's a terrible price for something that gives me a $2 profit at expiration or a $7 profit, which is fine, but I have to wait all the way to expiration. So that trade doesn't look good. If I just want to sell, I think we're going to have direction, and typically November, December, and January directional. And so I don't want to say like, well, I'll just sell premium because the market shouldn't go anywhere. Well, that's not true, because more than likely the call side will get tested. So if I'm looking to sell anything options wise, I'm looking to sell here, sell premium and see if the market just stays above those lines in the sand. So for an options trader, that's also why I had mentioned this last week, and I'm not sure if the team is showing this in the chats or if you're talking to one of the team members at A1 Trading. If you purchase the gold VIP bundle that I know we're running some big Black Friday sales for A1 Trading, if you purchase the big bundle, so you've got your A1 Trading, you got the Edge Finder, Stock Box, VIP membership, gold access, trade alerts, all that stuff. If my trade alerts are included in there, I've got a full strategy course called Practical Options that I will give to you. And that is 13 strategies, a PDF, and 11 videos on all the stuff I talk about here in these live sessions, especially when it comes to options trading, making sure that when I mention a strategy or talk about puts and calls and, selling versus buying, that it starts to make a little bit of sense. So within about 3 hours, 4 hours of education, I get you up to speed and actually have you understanding options if you like trading it. I love trading options. It's literally about 90+% of my portfolio. It allows me to position for longer term with way less capital. It allows me to generate a lot of income, week to week or month to month without having to tie up a bunch of money, and also have dry powder at the ready. So when good opportunities do present themselves, it's very easy to deploy and put in the capital that I want at a much better price. So there's a lot of ways to trade it. It's super flexible, and that is why I've loved options for the last 6-7 years now. All right, food for thought. Okay, so where are we? We're right here on the 50 period moving average on the S&P. NASDAQ, same type of thing, pulled back to the 50 period. We got a couple of daily candles. We got a gap higher, gap lower. It's the same situation as the SPY, right? Here's the S&P post FOMC gap, and there's our gap from last week. So is it possible for price to go both areas? Yeah, it's possible. We could have a double gap fill, right? Does that give us any clear direction? Not really. So what I'm positioning for longer term is I just think the market's going to find a way to get to highs again. Okay. If we get a pullback, I mean, pretty well supported. I mean, even pulling back in this 200, pretty well supported. So even getting a 100, 144, 200 pullback levels, I'm still looking to revisit highs or get some support. Okay. This is probably more unlikely than anything else. I think right now the market's like, just get the election out of the way, and then the market's ready to, kind of resume either revisiting highs or even resume an uptrend. Go to the Dow, same thing. The Dow's actually had what almost looks to be a little bit more threatening, because we took out this previous low. We filled actually this FOMC gap. And I'm wondering if the Dow is, I don't know. I mean, maybe the Dow, same thing. We just have some lower highs and lower lows. This would be a 100 period. I mean, I'd probably take a position on the Dow, position on the Dow, position on the Dow. So any deeper pullbacks, I'm just going to stay long for right now. And I'll stay long until price proves otherwise. I mean, I know pullbacks looks like gradual pullbacks are not a deterrent to say like, oh my God, the market's falling. So what I have going to the downside right now are hedges. Okay. I've got to trade in on ES right here for the 8th. 1, 2, 3, this trade right here. Okay. This, if you can see my little flag, this is on my broker chart. So this is the real price right now, and it's in profit. Now for full profit, I can take this all the way to expiration, which is Friday. And I also have a profit trap. So right now, ES, which is the S&P futures feed, this can go from 57.65 all the way up to a pin price at 58.90. So is it possible? Let me check this on my table for ES. If I go out to the 8th, how high is the expected move? The expected move is around 59.05. Now that means that it could actually cause me to risk something on this trade, but you can see my levels. 58.90 is my pin price, and that looks like this. On my options trade, this price right here is my max profit of around $3,500. Okay. This all the way out here. So where price is right now, because price is lower, this is around $1,000 of profit. So as long as price stays below 58.90 this week, I'm looking at about $1,000 of profit per account. Now, if price is going to go higher and start to threaten, 58.75, 58.80, 58.85, I still have that profit trap, which is a 3-to-1 on that risk. Okay. Now, the easy trade is price just stays where it is or goes slightly lower, and this is a full $1,000, and I just take the profit and be happy. Okay. But that profit trap is there for a reason, because, number one, it's a hedge. I don't necessarily think this is going to be a winning trade, but if it is, that's good, because at least I'm offsetting some gains. But, I've got some good P&L floating on the day. Price is cooperating. We're kind of in between a couple big levels. We got a lot of drama happening this week, and we'll see how things go. But right now, to the downside, I've got some hedges. I'm long MES, I'm long MNQ, and those are just to see if the market drops to take some profit. And then I've got some index trades as well. But otherwise, I'm just going to position for longer. I want to go out to December, go out to January. I'll look to see if the market can revisit those highs. Okay. All right. So let me keep going top down here. Russell hanging in there. This is another one that, especially with the rate cut scenario, if the market's liking this rate cut scenario and Russell's looking to maybe outperform, this is still one of the indexes that has not hit all-time highs yet. Okay, all-time highs in the Russell are all the way up here. IWM, it's like 244. So we still have potential Rip City to the upside. I mean, maybe not. But if we do get to all-time highs, that would be a nice, awesome run towards the end of the year. Is trying to get Russell to all-time highs, and maybe it just outperforms. But if we see green across the board, Dow's up, Q's up, SPY's up, so all your major ETFs are up, but your base of your broader market indexes are higher, I think the Russell could possibly outperform. If that's the case, great. There's more upside potential to get to the all-time highs, which we haven't seen since 2021, by the way. And that would be a run of almost 11% over the next maybe 3 to 6 months. So if the Russell can get to those all-time highs, maybe that's an 11% rip on the Russell, and then you have like 3-4% on the S&P, 3-4% on the NASDAQ, maybe 2 to 3% on the Dow. If we have a broad market rally, I would expect maybe the Russell can just outperform. Okay, volatility index. We're sitting here pretty elevated going into the election, which is not a surprise. If I go into term structure, this is another thing we got to pay attention to. So the market is still anticipating that there's going to be higher volatility going into the election, okay, and into the next couple of months. So this is markets anticipating that the front end on the VIX is going to be higher than later. So it's not super long, but like November, December, slightly higher volatility, and then things settle down, and then we get back into this would be our backwardation cycle for the next couple of months, and then we flatten out, and then we go back into contango. Maybe that's crazy to go out to like June and think we're going to get back to like the normal. The VIX term structure should look like this. That's usually what VIX futures looks like, and that's contango. That's the usual look. So anytime it's tilted downward, that's backwardation, which means the risk is way more near term than it is long term. So I'm going to keep a close eye on this, but we basically need to get through the next couple months without some crazy risk on event, or I guess risky event. Risk on is fine. Risk on is, everything goes up, but risky event, meaning like things get a little wild and crazy. So market's still anticipating some drama around the volatility index. We have been elevated since the August 5th bottom, which was our vol event right there. It stayed above like 16 or so, 16, 17. And we've gone up around 24. We haven't broken 24, but that's been a lot of volatility, just kind of sitting there in the markets without a lot of direction. Yes, we've hit all-time highs recently, I think the S&P is up 47 all-time highs this year, which is pretty impressive. And possibly after the election, if things settle back in and the market starts gravitating back up towards those highs again, then I would imagine the volatility index heads lower. I just want to know, are we heading lower into these recent lows? Are we heading lower back into where we saw lots of low volatility back here? I mean, I'm pretty interested in getting back into the low teens. If we get to the low teens, number one, that's a great rally spot where if the VIX drops into, let's say, 13 or lower, the ability to stay long there and have a lot of upside potential on every major index and a lot of stocks broadly stock markets go higher. If we get below 13 on the VIX, that's going to be an awesome rally in the market. If we stay somewhat elevated at 16, 17, and we stay capped at 22, then maybe it's limited upside. But once we get back into the teens, I'm probably looking at like a Q1, Q2 long vol play into 2025. Because getting back to those levels, that'd be a huge drop in the volatility index, and I'd look for some type of elevated volatility going into next year. So again, lots of stuff to kind of factor in. Dollar index, pretty convincing candle on the dollar. I'm still going to have the patience just to wait. I know it seems crazy. The dollar's dropping. That's fine. How many traders are already long against the dollar? So you buy euro dollar, buy Aussie dollar, buy New Zealand dollar. I'm long pound dollar right now, which is actually working out pretty nicely. So here's pound dollar, currently up about 90 pips or so on that pound dollar. Dollar CAD, I had a breakout trade at 40.25 that I told traders it has to get filled. Hasn't happened yet. So that's a pending order. I'm still waiting. Aussie dollar, I was hoping to come back down to support. We had a big gap higher. Here's another thing that's rare in the Forex market. Having the dollar gap like this, that's ridiculous, actually. Let me check and see if that's a live feed. Let me go to another broker here. Let's go to Oanda. Oh, yeah. I mean, okay. I'm just going to throw this out there. There's the close from Friday, and there's the open today. Now, yes, we wicked a little bit, but one thing that happens in Forex, gaps don't usually go without getting filled. So either this is a big institutional side move where this is going to be just a major pressure on the dollar, or this is a gap that's going to get filled by the end of the week. I wouldn't be surprised if these dollar gaps get filled. So I'm not heavily positioning on this stuff. I think the dollar's still a wait and see. I'd rather be, looking at the election and everything this week and say, okay, it's now, okay, let's say the dollar just breaks aggressively lower. Okay, well, if it pulls back, then we can sell pullbacks and then take it back down to these lows. Or if we get, let's say it's aggressive, then we get bear flags on smaller time frames, bear flags, that's fine. But what I don't want to do is say, oh, the dollar looks so good today. And we're having the same conversation on Wednesday, Thursday, Friday, and the dollar's all the way back up here. So I see the gaps on the currency side. I would be careful on those because gaps in Forex usually don't last. If they open from a Friday to Monday or Friday to Sunday night and there's big gaps, usually the market's going to find those spots and fill them. So just saying, I wouldn't be surprised if those gap gets filled. So just be careful out there on dollar position. All right. Okay, oil still hanging here at the lows. I'm not calling the floor. I think pressure to the downside on oil means, good things for inflation. If we break the lows, then we get lower prices on oil, lower gas at the pump prices. That's all good for inflation data. Okay. If oil stays here and choppy, or I don't know, Middle East stuff, it's not really causing prices to go too much higher for right now. So we'll see. But I'm not doing anything on oil. I would say be mindful of the lows around $66. If we break firmly below that, then we might be heading into 50s real easily. Same thing on oil futures and CL. NG, this is all over the place. I'm just staying out of this. I'm hoping natural gas will pull back into a respectable low, but if it does, awesome. If it doesn't, I'm not trading it. Gold, okay. Gold is fine. Let gold do its thing. I want to pull back on gold. Look, I'm probably not going to add any more if gold goes higher and goes higher and goes higher. I'm just going to ride the current positions that I've had since back here. I'm still long that far back. Okay. Income trades in here, income trades in here. I haven't really added much as this market has gone higher. So I'm still hanging into some profits, letting some option trades expire, still owning shares of GLD. But what I'd like to see on gold would be, there's a 21, there's a 50. Give us a pullback, and I'll start repositioning my GC, which is gold futures, GLD, which is my shares, my ETF shares, and I want to just buy some dips on gold. That's it. It's pretty simple. So especially if central banks are cutting rates, gold should be looking better for interest rates. Also, it's an inflation hedge, also a store of value, also a dollar alternative. It's been one of the best looking, healthiest bull markets we've seen this year in the markets. That doesn't look insane, right? It's not an SMCI, which was, who remembers this year? SMCI was one of the best performing stocks all year. Now it's absolute trash. Okay. So don't fall in love with the stock. Here's SMCI. This thing was one of the best performing stocks in the entire year. It was up almost 300%. Okay. In January of 2024 into March, one of the best performing stocks. Now look at it. It's given back literally all of its gains and it's negative on the year. So that's the craziness of stocks. Going to the gold market, it's just looked a lot healthier. We've had nice pushes and pauses, lots of time to accumulate. Market keeps making higher highs. I just said I want to pull back because we're a bit overstretched. You know, we have a decent stretch between the 200 EMA. We're out about 274 bars, but since we've seen it, percentage wise, it's at a high enough level around 13%. I said somewhere like 15 to 20%. If we get overstretched about 15 to 20% above my 200 EMA, I'm looking for gold to struggle a little bit. You know, I'm not calling the top on gold. I'm just saying that if we have a 13% stretch between my high and my 200 EMA, that price may just revert a little bit, come back in for some pullbacks, and then we can go higher from there. That's fine. But I'm just trying to avoid like this. If it gets really overstretched where gold's way up here and the 200 is, 20% away, usually gold kind of tops out and then starts to revert slightly. Okay. So that's all I'm saying. Just, I'd like to see a pullback. That's my preference. If it goes higher, cool. I enjoy the melt up and I'll just enjoy some more GLD gains, SLV gains, GC, SI, just trading futures, trading some income. But if we get pullbacks, cool. Because I want to buy some dips and I want to add some exposure, and it's going to be at really any of these levels. 21, I'm not that interested in because that's the near term. But if we get a 50, probably where I'm going to put in a trade. So I'd say from the 50 down to the 200, I'm looking at some option trades on GLD and or GC to stay the course on gold. Okay. All right. So there's GC, same thing, looking for pullbacks there. GLD, same thing. XAG, this is silver, pretty well supported. Come back into this area, try to get to some fresh highs. First target for me is still 35.88. I've got a covered call on my SLV positions at 35, and I guess unlikely to get called away for now. Bitcoin, we had that big rip last week, came all the way back up near the all-time highs, not to them, not through them, but near them. So near all-time highs, pulled back. So what happens next? I don't know. We'll find out. We are making higher lows. That's a good sign. Okay, backside of this trend line, could we end up just pulling back to here, backside of the trend line, and then starting to go bullish to revisit highs? Sure. Bitcoin looks pretty good. Now, I will say that my opinion on Bitcoin can change very quickly if we take out, let's say, 62.5. If we come all the way back down here to 62.5, do we take out this low? Are we breaking that trend line there? Are we going to make a lower high and a lower low? Could I make a case for bearish Bitcoin? Sure. If price proves that it's taking out some of these lows and changing structure, then maybe this is nothing more than a big fat range. Okay, where this is major resistance, this is major support. But what I see right now is this thing looks better, right? To me, this looks better than just it's a top or a bottom. To me, this is, if we're making higher highs and higher lows and we blow through this 74,000 level, I could say that a lot of traders should be excited for about 100K to, I've got a measure move at symmetry around 107. I mean, I'm as excited as anybody else if we get above all-time highs on Bitcoin that we're probably gunning for 100K. So If that's the case, great. And there's lots of ways to trade it. I might be looking at Bitcoin futures if I get filled on them. That's the hard part, is the expirations that I see on Bitcoin futures are not that great. So Bitcoin futures, I mean, I've got contracts out to December and January. I could do, I don't even know if I love this trade. If I did a 69 by 7,000, I mean, I can spend $2,100 to make $2,900. I don't like that at all. It's like something about this Bitcoin futures market is just not as good as just trading Bitcoin or even MicroStrategy or IBIT. It's like there's just better ways to trade it. Unfortunately, I just don't think the futures market is what it's priced out where it's just way too large. You're talking about $1,000 in between strikes. So it's great to be right, but I'm not going to throw out one trade that's going to cost me 1% of these accounts if I'm wrong. So I wish there was a better way to do like more risk-defined trades, but more than likely I'll just stick to IBIT, BITO, FBTC. MicroStrategy is fine for income. Coinbase is okay, but it's not trading like Bitcoin anymore. Some MARA, I've got some exposure on that for some digital mining stuff, but yeah. Otherwise, just buy Coinbase. I mean, in Tasty Trades account, you can buy Bitcoin for nothing. So if I go BTC, if I go GBTC, that was another one you could trade, GBTC. This one's trading at 54. There's no options on this one, but go to the price on GBTC. Interesting. Like it's also not so IBIT is the only one that really looks like it's correlating the same way that Bitcoin is. So there's Bitcoin, there's IBIT, there's FBTC. So your BlackRock and your Fidelity ETFs are the closest resemblance to what the spot price of Bitcoin is actually doing. Okay, so anyway, we'll see. Post-election, if we break all-time highs in Bitcoin, that gets exciting. If Ethereum can make a comeback, we got to get above 28.15. We'll see what happens there. Copper looking a little bit better. Is China up today? A little bit. JD is flat on the day. HSI's up. Alibaba's up. Baidu's up. These are good. I mean, I'd say they're stable. They're not good. This is another thing, maybe getting through the election this week. If we see another round of like lifting animal spirits and China stimulus, more vocal, another, let's say $100 billion in US dollars put into China, or 5 trillion won, or whatever the heck they need to pump in. But I would be wondering if there's more stimulus ahead for China, and if they do it by the end of the year, or if it's something we're gonna have to wait on. So FXI is stable, KWeb is stable, JD is stable, HSI is stable. But we're still going off that crazy rip we saw in September, and I'm just wondering if we get back up to it. So this low, this high, market got all excited. That was during a 2-week holiday, by the way, where there's very little trading. And then the market's like, yeah, we'll see. So I just want to see if we come back and revisit those highs. If we do that, protecting some profit and not forcing a bunch more trades, my exposure on China probably goes out maybe to Q1 next year. That's about as long as I want to hold some of these. Unless it's risk-free, and then I'll let it run. Like risk-free on Alibaba, risk-free on Baidu, I'll let those run. JD, I've got an income trade on. I'm trying to get it back up to like $41. I've got a $42 covered call that's out to this Friday. If it gets called away, that's fine. I'll still make some bucks on it. My break even is around $40. So I'll make around $2 a share. And I've got, I think, 500 shares of JD. All right, what else? We did gold, we did silver, copper, Japanese yen, not interested. Nikkei, still just super choppy. I'm going to keep an eye on the Nikkei, but I don't think Japan's going to do anything wild and crazy at this time. Let's go to the DAX. So German DAX, same thing on some of these moving averages. We pull back into the 50, the 100, the 144. We've had a decent little run. Are we able to pull back, generate some good dynamic support, and then try to get back up to those highs again? Trend traders do this. Trend traders look to buy with tight stop losses. If they, have reward to risk, let your profits run, eliminate risk. It's pretty easy. So if you dollar cost average into these areas with stop losses below, you get the effects of all this potential support. You turn each one of these trades. I mean, think about the difference here, risk profile to reward. That one has the least amount of reward, right, as far as getting back to the highs, but then it gets a little bit bigger here. It gets a little bit bigger here. And it gets really big down here. So you have, as you kind of dollar cost average in, you're getting higher reward to risk with all these dynamic support levels. And I still want to have a plan if I was going to stop myself out. I mean, as long as price isn't invalidating, then we are catching support and we're looking to see if we get back to highs or go higher. So just think about that when it comes to reward to risk. Okay. All right, that's German DAX. We go the FTSE, the UK, still very choppy, also sitting at that 200 EMA. We're able to get back to all-time highs again on the FTSE, maybe. Not a bad spot. I mean, if you're long in here, stop loss below this nice trend line structure that goes back into late 2023. If we get back to the recent highs or the all-time highs, then reward to risk looks pretty good. Bank of England should be cutting rates this week, right? They are expected to cut rates on Thursday. So we've got the Fed and the Bank of England on Thursday, looking for a 4.75 rate. What else? Mag 7, down from last week. Apple is down. Amazon actually had really good earnings. We're trading at 197. Had a nice trade on Amazon last week. Got up to $200. Turned that little butterfly into a nice little trade. I'm still covered on Amazon shares. Google trading at 169. What a fallback that was. We got up to 181, fell back into 169. I still got some bull call spreads by 160, 165. Meta just off the all-time highs. I like to see Meta pull back a little bit deeper if possible. A little deeper would be great. Beat on top and bottom last week in earnings. So a little deeper would be awesome. Microsoft, this one, so I've got a 430 by 435. I'm looking to see if it pulls back just a smidge lower. I might not get this trade, but if we pull back into like 400 or 395, I'm probably going to take this trade, which is one contract, and do the same style of strategy for two contracts. So in this one, I could lose 265. Okay, and if I do two contracts, even if I take the same price, that would give me a 235 profit times 2. So I make $4.70 here and I lose 265 here. I still make money on the trade. So I'm just going to wait a little bit and see if I get a chance to get into two contracts on Microsoft. Netflix, sitting here near all-time highs. I mean, Netflix has been a great one just to have in your portfolio, a dollar cost average. I have some income trades all the way down here for profit. Took an earnings play as a bull call spreads. That worked out nicely. Owning wise, I mean, I'd like to take some of that cash I have at the ready and buy more Netflix, but I'm not buying it at all-time highs. I'm just not. So if we get a gap fill, great. If this can't really sustain the highs or we get a pullback here, you're looking at a gap fill. I'd love to see some dips. Otherwise, I'll just keep trading a bunch of options and stay the heck out of the way and just generate some income, but not have to own the shares nor buy it high. Nvidia, off the lows from Wednesday, had a nice little pullback level. I think Nvidia pulled back, 5 or 6%. Even more, 8.4% from top to bottom, or roughly. So am I long Nvidia? I mean, through ratio spreads, through higher implied volatility, but not necessarily getting gung-ho about buying at all-time highs or close to it. So same type of thing. This one's been over 400 and some bars since we hit the 200 EMA. So I'd almost love to see Nvidia do this. Come a little bit lower, buy the backside of this trend line, find some 100, 144, 200 support, then way more interested in buying longer term Nvidia. Okay. All right, what else? Tesla, 248. Sitting here with a January expiration. I do think that Tesla has potential to rip a lot higher. I think if Trump is president, I think Tesla's going to rip a lot higher. I think everything that Elon Musk is doing to support Trump in the way he has been because he's trying to get some favors in the White House over the course of, developing AI or chips in the US or even going humanoids and automating and beefing profit lines. I mean, I don't know. So I'm long with the intention of this. It's a credit spread that at 270 by 265, I pulled in more credit than I'm risking. So I don't have to do anything on the trade outside of, well, if it goes down, then I will own some shares and I'll use my long put to lower my cost basis. Okay. If it goes higher, then it's just income. And if we break and go higher, I mean, I'm looking at A nice clean break above 275 or so, 280. I think this gets all the way back up towards 400. So there's some open space up here that I'd like to be active in, probably just trade a bunch of option trades. Credit spreads, debit spreads, just be long. There's ways to do that. So if it pulls back though, I mean, you can see my wedge. This is lower highs and higher lows. So we just have this big wedge that's going on. A pullback is fine. I'll own some shares in the low 200s. If I have an opportunity to own shares in the 200s, I will own in the 200s. So let me go back to Tesla here, make sure. I'm pretty sure I didn't get assigned in anything. Let's go to this. Tesla is here. So currently no assignment, just credit spreads, ratio spreads. That's it. Tesla is up around $4,700 for the year with owning like no shares whatsoever. So if I own shares, I think I can easily generate $5 or $10 a share just using some covered calls and a quick wheel strategy. Why January? So I give myself time. Just time. I mean, if this one makes a nice little push, great. January I can have it expire in full profit. I can do more of those trades and actually stack in some nice profits. Example being, if I want to do it right now, if I want to do a 250, let me look at this right here. So this is a sell put, buy put, which I'm okay owning. If I look at Tesla right now, okay, Tesla right now, and I go out to it, so the strikes will be different. That's a good thing. If I go out to January, you can see my bull put spread right here. If I were to buy a 250 and sell the 255, I can risk 228 to make 275. Okay. The only issue with that trade is if I lose on that trade, that one's going to be a loser by expiration. On the credit spread, I can actually own the shares by closing out the long put, taking on the assignment, and then repairing the trades because I'm willing to own the shares at 270. On a bull call spread that's cost effective, there's no risk of assignment, but I could just space it out. And that's not bad. I mean, 225 to make 275, that's a pretty good trade. And out to January, it's like, well, can we go higher? I hope so. So, I mean, do I love the trade right now at 250? Not really. But if I get the trade at 250 by 245, or I guess it was 245 by 250, so if I buy the 250 call and I sell the 255, if price is above this by January, that's a good thing. That's all I need. So let's see. If this trade is profitable, then I make 268. If this trade is profitable I'm looking at right now, then I'll make 275. So without owning a share, I can make about $510 without getting any assignment. This one I can assign and work the trade back to profit. This one I can't. This is more of a binary. I win or I lose. But I'd say January just to go out enough time to see, okay, if we have this end of year rally, typically November, December, January, very bullish for the markets. If it is, maybe it's a broad market rip. So it's not a bad trade. Question is, do I like it enough to take it? So if I like this trade a lot, it's probably back down here in the 220 zone. However, you know what? I'm gonna take the trade. Fudge it. I like it enough. Out to January, I'll take the trade. So 250 by 255 only cost me 225. I'm gonna take the trade. So 225. I don't want to pay more than 230 for it. I just got filled to 225. Okay, let's go. Getting filled at 225. Very nice. Okay, so that just got filled. I'm going to add this into my Pulver alert section, stock options. This will be a new trade on Tesla. Going out to the 117.25 expiration. I'm buying the 250 call, selling the 255 call. It's going to cost me $2.25 debit. So that's a 225 max risk per contract and 275. 275 max profit per contract. Looking to see if Tesla is able to rally bullish November to January. Okay. And I'll add that in here. So buy the 250 call, sell the 255 call, 2.25 debit. Okay. And highlighter on this one right here. Okay, that's in Discord. Throw that into my personal tracker. And then if I have to go at the top of the hour, let me know. Otherwise, I'll go just a few more minutes here. But not a bad trade for the day. Lots of trades to go through. Come on, man. Where's my... Okay, I'm on line of my spreadsheet here, line 322. Tesla 117.25. Buy the 250 call, sell the 255 call, 2.25 debit. Okay, tracked and in. Got it. Okay. Would you double up on Tesla, put spreads like Microsoft? I don't have to double up on it because if I like Tesla enough for ownership, then if we go down here towards this 210, 215 zone, I might just close this trade out where I take the 265 long put and close it. And then I await and see if the broker is going to sign me at 270. Because then I would own shares at 270. Okay. And I collected 268. So, I mean, what I would be doing on Tesla would be if I could own shares in the low 200s, here's what I would do. So let's say price goes down to like 215. Well, 265 minus 215 is $50 of credit. So I take the shares at 270, or I wait assignment at 270, take away the 268 from the original credit spread, and then take away $50 on the long put. I could own shares of Tesla at 217. If I go out and put a covered call on that for 30 days, I could probably get $8 to $10. So let's say I get $8. I lower it by another $8. I own shares at 209. I get it called away at 225 or 230 or 220 even, or 215, and I can repair Tesla pretty easily for income. So the reason I don't have to double up on that with a credit spread is because I can just take the assignment. So if I wanted to, at some point, if Tesla's down enough that I want to own it, then I would just close out the long put early and then wait and see if the broker actually assigns me. There's also a chance because, I'm trading American option style, which means that anytime the buyers and sellers, they could be paired together, I could be given the shares by somebody else in the market. So somebody exercises the right to sell, then I'm obligated to buy. That's the way the option is going to work. So if the broker assigns me early before my expiration, that's fine, but I'll still use the long put as my hedge. Right. So I don't have to double up on Tesla like I would on Microsoft, because Microsoft is a bull call spread, which is a debit. I would just double up because that'd be another debit spread. Make sense? All right. Cool. Bond stuff. So the 10-year was down 2+%. Now it's coming back a little bit. So we are, up. I mean, it's interesting too, like watching the dollar gap the way that it did, it pulled the yields down. So I almost wonder if a weaker dollar is also going to drive yields lower. I mean, for me, just from a personal standpoint, from, financing a house in the next 6 months by 2025, I mean, I want yields to drop. I'm not long bonds though. I honestly like. I'd rather be in gold and silver. I'd rather be in Bitcoin. I'm staying out of bonds. I had a nice run on TLT, made a nice chunk of profit. I consider that timing pretty solid. I played that with the intention of the Fed cutting. They did. That trade worked out great. I'm just glad I wasn't sitting there like holding the bag, hoping that it went, bonds went higher as yields went lower, but it didn't. It completely flipped. So anyway, I'm not in bonds. I hope that yields go lower. Okay. All right. Currency futures. Actually, oil futures, man, oil futures is super volatile, but I'm curious right now. So oil futures, what's the expiration I'd be looking for here? 11 days is like no time whatsoever. But if I did, let's see, CL prices. I'm just curious what it prices out to be. I don't know if I'm going to take this trade or not. But if I said, okay, to the downside, we don't really go below 65 and we don't really go above 75. I mean, that could be a pretty good trade. So 75, if I did a sell call, that's a 26 delta. Oof, that's a little high. I could go probably lower than that. Let's do like a 15 or 16 delta at 78, and then do on the put side, same thing. Maybe a 15 delta at 66, 12 delta. Okay, so I'm getting way more premium on the call side. Interesting. So on the indexes, you're getting more premium on the put side. On oil, you're getting more premium on the call side. Okay. Let's go down to like the 15 delta. So if I do an iron condor here, let me see what the risk would be. If I go 66 by 65, 78 by 79, I just don't love that trade. It's risk defined, so I mean, I don't lose a ton. The idea would be to manage some profit out of this 210 credit. I don't know. Nah, it's not worth it. I mean, it's about a 10% return on capital for the buying power. Return on equity is not bad, but risk is certainly greater if I lose. So never mind. I don't like it. I'm just staying out of oil. So summary for me today. We have a lot of stuff going on this week. Elections tomorrow. We'll see how dramatic it gets. We got the Fed on Thursday. We got 1,000+ companies reporting earnings. If the consensus is good, that's fine. It's really, I don't think the market really cares. I mean, I think the market cares if we have a Republican sweep or we have a Democratic sweep. I think the market cares if it's maybe there's a threat of policy change, maybe there's not. I mean, probably the ideal situation for the market to rally. And again, this is just opinion. I think the market would probably rally higher on a Trump victory because there's probably more benefits coming to corporate America. There's probably more benefits coming to just healthy tax cuts for wealthy. Trump will probably induce a bit more of a rally as far as like right out of the gates. Okay. Now, is a Harris victory going to be the end of the market? No. I mean, it's going to be the same policy we've seen for the last four years. We're still going to have fiscal spending. And crazy stuff is like government's taking in about 60+% more over the last 20 years, like 60+% more tax revenue than it had back in like early 2000s, but they're spending 93% more. So it's not a tax problem, it's a spending problem. And both parties right now in power would very likely be adding to the deficit. And right now, from what I'm reading, Trump's probably going to add $6 or $7 trillion to the deficit. Harris or Democrats would probably add $4 trillion. Government is still going to spend. So I don't think the market really cares. I think if it comes to policy shift, Republicans are probably more pro-business, deregulation, better tax rates, right? But the spending problem is still going to be something that cripples the economy down the road. I don't know. I don't think this is going to be the greatest ending. We've had a great run. We've had an awesome expansion. We dodged, we bobbed and weaved and we dodged all these recession threats. But that's also why it hasn't happened, because everyone says it's going to. It's like people learned from 2008, and so they're just planning around never having 2008 ever happen again. Okay, people learned in 2020. Well, we'll never let that happen again. It's like, look, somehow the market's going to cleanse and purge and reset, and we have to either have the cash to absorb it and deploy and buy at discounts, or we're going to be fully exposed and get torched. I'd like to be in the former camp, which is I have cash at the ready to deploy, and I just try to generate income without taking up a bunch of capital. If the markets melt up, cool. There's money to be made. If the markets blow the tops off, cool. There's money to be made. If the markets drop 5, 8, 10, 15, 20%, it's going to be painful. But knowing that I've got cash at the ready to deploy at discounts probably sets me up for longer term success than being fully exposed and getting hurt, badly on a pullback. Make sense? So, all right. So we did everything. We did all the indexes. We did dollar. We did gold, silver. We did Bitcoin. Things to watch. We did Mag 7. I mean, pay attention to your prices. All I'm doing on my charts, I've got a lot of simple moving averages here. These are all exponential, so I don't want to say simple because that's an actual moving average. But these are exponential moving averages: the 21, the 50, the 100, the 144, the 200. I'm not saying I'm going to wait all the way until the 200, but I would like to see if the market is capable of pulling back into, like, let's say a 100 before we find some footing. Okay, if this is all we get is a 3% pullback and this market goes higher, fine. I've already added some trades in, but they're mostly just income trades. As far as like my heavy deployments, it's going to be at deeper discounts. And I don't know if we're going to get them. But if we do, I want to be at the ready. If we don't, market melt up is fine. Remember, November, December, January are 3 of the most bullish months in the market. If you take a look at Edgefinder and go to the seasonality, you'll see that. And on top of that, one thing to look at, I did this in a live session last week. Wednesday of this week, the day after the election, if that candle on Wednesday for the S&P closes red or closes green, that's a typical indicator of about a 2 to 4 week trend. So if we close green on Wednesday for the S&P, I'd like to be bullish. If we close red on Wednesday, I'm going to be bearish. Only in the short term, but looking to actually follow some trends. I'm going to go month to year trends, November, December, and January. So here's a good look at it. Okay, so for the last 10 years, okay, December to January, February, that's a pretty good window. Now, November, it's interesting how this actually shows like flat the last 10 years, 0.05, I think is what that shows. So it's flat. And this is not necessarily taking into effect the election years, but we have a couple things, right? First half, market was over 10%. Probability is the second half is going to match that or be beyond that. Now we're up 20+% already, right? We're up 20+% of the S&P, but just maintaining that as opposed to giving it back. Probability is we find a way to stretch higher. One thing that's never happened in the history of the stock market is to have gold up 25% and the S&P 25% in the same year. It's never happened. So can it happen this year? Sure. Maybe that's our big outlier. Gold is up and the S&P is up. Everything's up. It's the easiest bull market in the world. Even though it's not. It's been a weird bull market. It was highly concentrated, AI bubble, pullback and flash crash in August because of the Japanese yen and other things. But, market's resilient as it always is. So could we have some weird correlations? Yes. But are there ways to make money if we melt up higher? Of course. Okay. But from November, December, January, even into February, those are some pretty good months to just be focused on being bullish. Okay. Now, if we get the traction to show that we're going bullish into November post-election, that's probably a great thing. What's the Fed going to do to derail it? Probably not much. They'll just cut rates. They're cutting rates November this week on Thursday, most likely like 99% probability. And then in December, another rate cut before the end of the year. Now, 2025 is a whole different story. Because if they still cut rates and the market's melting up and inflation data shows that it's getting stickier, getting higher, CPI is up plus 2.6, 2.7, 2.8. It's a big difference. Okay, I already saw in a podcast I listened to this weekend. Forecast for CPI this next print for the month of November is going to be a 2.6 CPI. We're just at a 2.4. It's not a good thing. That's not trending the right direction. That's not going down to the 2% target. That's getting stickier, right? So anyway, we'll see. All right, before I leave today, I know there's some links in there for Edgefinder trial. We had the Black Friday special. It's still going on. Get your hands on an awesome discount on the Edgefinder Pro, plus a stock box, Pulver alerts from Nick and Frank and the team. So, they're hooking you up with some great deals for the rest of the year. And, I'm happy to be a part of it. Anybody that's buying the big fancy Gold Star bundle, Gold VIP plus alerts, things like that, I've got a full options course for you, free of charge. I'll just include that if you buy the big alerts and the gold bundle. Okay. There you go, 40% off Black Friday sale. By the way, also on November 12th, make sure you register for the webinar that Nick and I are doing to talk about the remainder of the year. This will be post-election, so this week and going into next week's webinar. Looking forward to doing that on November 12th at 10 a.m. Eastern time. It's a free webinar to attend, but you have to register for it. So make sure you get registered for that session. There you go. All right, thanks everybody. Have a good rest of the day. See you soon. Bye.
Attention! The Black Friday sale is happening now. You can get 40% off everything on a1trading.com, including the brand new stock box, Pulver alerts, the Edge Finder, and more. Thanks for watching today's A1 Trading Show. Make sure to subscribe and to leave a like down below if you enjoyed. If you'd like to join the show, you can become a guest with the link in the description below. That's all for today, traders. We're heading for the moon.